Welcome back to Lazy Genius Investing. I'm your host Saveen Kumar, and today I'm going to take you back to my very first attempt at investing. When you've got very little time outside of work, family, and the occasional scroll through LinkedIn, your investment goals start to sound like this. Simple and safe, please. Naturally, my first choice was mutual funds. Simple, familiar, and no need to stare at candlestick charts like they are hieroglyphs. Why mutual funds felt right? Well, mutual funds came with some solid perks. 1. No stock picking. Someone else does the heavy lifting, you just fund it. 2. Fewer compliance headaches. Super helpful if you work in regulated companies like the Big Four, banks, wealth managers, or hedge funds. Oh, and let's be honest, some of us actually enjoy a clean audit trail. 3. Lower trading fees. At least until a few years ago, especially compared to regularly buying stocks or ETFs with the usual vendors. But of course, as with all things in finance and life, there is no such thing as a free lunch, unless you are at a corporate offsite. For all their convenience, mutual funds come with some limitations. 1. Little room for skill. If you are actually good at analyzing stocks, mutual funds feel like investing while wearing oven mitts. 2. Manager ruling. That top performing fund is often only as good as the person managing it. But people can leave, or burn out, or get poached by a rival firm. 3. Overlap hell. You think you have diversified with 20 funds, but surprise, 15 of them all hold Apple, Microsoft, and Amazon. Congratulations! You have built a Frankenstein ETF. So, what did I do? I set up a systematic investment plan. Just a fancy way of saying a fixed amount got invested each month. Set it, forget it, go back to my spreadsheet. When choosing funds, I looked at number 1, performance, because obviously. 2, geography, US, UK, Europe, Japan, India, Asia, because flags equals diversification, right? 3, asset class and style. Equities, bonds, large, mid, small cap, value versus growth. I also asked myself, could a passive fund do the same job? Are the fund's top holdings truly diversified? Say if 2 funds shared more than 25% of the same holdings, one of them got axed. I rebalanced once a year, like a dentist appointment, but with fewer lollipops and more Excel. The results? Let's just say the returns were fine. Not yacht level, not disaster, somewhere between meh and okay. But let's be fair. The market has not exactly made it easy. Brexit, COVID, Russia, inflation, interest rates, US tariffs, and now DeepSeek AI taking over every headline. Plus, here's something people forget about dollar cost averaging. It usually drags your actual returns below the advertised past performance. Why? Because you're buying at different prices each month, and some of those prices are not ideal. I was particularly disappointed with several active funds. In my experience, passive funds are cheaper, more consistent, and less prone to human drama. Yes, some active funds beat the market consistently, but finding them, that is like searching for a unicorn that files quarterly reports. Also note that diversification is not magic. Despite my best efforts, US tech outperformed nearly everything. If your portfolio was not leaning into Silicon Valley, you were probably underwhelmed. Bonds? Snooze fest. Real estate? Sluggish. Clean energy? Let's just say I'm still waiting for the sun to pay me back. Where I landed? I still park some of my long-term money in mutual funds. They're not bad, just not brilliant. But as I've gotten better at building repeatable rules-based strategies, I started shifting more towards customized equity portfolios. Because sometimes the lazy approach becomes a little too lazy. Next time, we'll look to the gods of investing for guidance. Yes, we are diving into value investing. Got thoughts, questions, or your own mutual fund journey to share? Drop me a note in the comments or message me on Substack. I'm at Tech Savvy Investor. Thank you for listening. I'm Saveen Kumar, and this is Lazy Genius Investing. Signing off. Peace.